In San Francisco, this is Bloomberg Technology. Coming up in the next hour, not an endorsement. Facebook CEO Mark Zuckerberg responds to a Bloomberg scoop that he recommended hires to Pete Buttigieg's presidential campaign. We'll have details. Plus, it is the unicorn you've probably never heard of. Instabase hits the $1 billion valuation mark. We ask the CEO about raising money amid public market turmoil. And speaking of the public markets, New York Stock Exchange President Stacey Cunningham discusses the popularity of direct listings and the atmosphere in a delayed Wework public listing world. But first, to our top story. Facebook has discovered 4 separate misinformation networks, 3 tied to Iran and 1 to Russia. Zuckerberg says it shut down the networks as part of an ongoing effort to counter foreign influence campaigns. This was on a press briefing call early on Monday. Zuckerberg also addressed a Bloomberg scoop in which he privately recommended several potential hires to the campaign of Pete Buttigieg.
This shouldn't be taken as an endorsement. We have several mutual friends from college who introduced me to Pete a number of years ago. I did a Facebook Live event a couple of years back, so it's kind of widely known that I had met him. And when a number of colleagues who I'd worked with at Facebook or my philanthropic foundation were interested in working there, they asked me or my wife Priscilla to send over their resume, and so I did that. I think that this probably should not be misconstrued as if I'm deeply involved in trying to support their campaign or something like that.
To discuss, I want to bring in Jeannie Zaino, Iona College political science professor and applied economics senior advisor, and also with us, Bloomberg Technology's Sarah Fryer. So Sarah, let me start with you. What did we learn about these emails and what Zuckerberg said about recommending some hires to the campaign of Mr. Pete Buttigieg?
Well, we learned that Zuckerberg, he has this relationship existing, and even despite becoming a punching bag for some other Democratic candidates, namely Joe Biden and Elizabeth Warren, and even despite concerns from the conservative side about whether he might be biased, he has chosen to give some support to a presidential campaign. And I think whether or not this is an endorsement, it is still a rare move in the direction of helping someone out. And so I think that we shouldn't overread into it, but we should note that this is a powerful person working behind the scenes on behalf of a presidential candidate to help them out.
And Jeannie, you say that while it's not illegal, it may not be wise. Explain what you mean by that.
Yeah, it's a risky strategy. And I'm starting to have questions about Mark Zuckerberg and Facebook's strategy in some of these instances. I mean, we talked last week, their response to the Elizabeth Warren advertisement, where he basically walked himself into suggesting maybe they should be regulated like network news. And now we understand that a few months ago, at least, he is suggesting people to work for a presidential candidate who at the time was, a second-tier candidate, is now moving up. These are risky strategies for the company as a whole. It would be one thing if Mark Zuckerberg stepped aside as CEO of Facebook and was doing this as a private citizen. He has every right to do it. There's nothing illegal. But it's also risky at a time when Facebook faces so many headwinds from Washington and from both sides of the aisle, quite frankly, Democrats and Republicans, who want to take a stab at Facebook for what they suggest have been practices that they find problematic. Elizabeth Warren being primary among them. Oh, yes, Pete Buttigieg's primary opponent. So I think it's risky all along, and I'm questioning where this advice came from, if anywhere.
And Jeannie, in all of your years of studying this and looking at this, What is the precedent? Is it abnormal for someone in the private sector who's running a big company to be doing this, or are we reading so much into it because it's Mark Zuckerberg?
I think we are reading a little bit into it because it is Mark Zuckerberg, but usually CEOs at this level try to be careful. Sure, they will donate to PACs and political campaigns as private citizens. Mark Zuckerberg has done that. You see that across the board with big tech and other companies, but they do try to be careful about choosing favorites. When we see those donations, they generally try to play both sides of the aisle or to donate to PACs in which they are donating to military vets or others. So I do think this is a questionable strategy, again, for Mark Zuckerberg. And I think we heard that in the clip you played where he said, please don't read too much of this into this. This isn't an endorsement, but I think he knows he stepped into it a little bit here. I wouldn't suggest this is going to be a huge problem for them if this is all it is, but I think he has to be careful going forward.
And Sarah, you've been covering a little bit about the policies of these candidates. So this is notable that it's not Elizabeth Warren, one of the bigger critics of big tech. What do we know specifically about Pete Buttigieg? Why this individual? Why this campaign?
Well, he has been a little lighter on tech. He hasn't said that we should break up the companies. And listen, this campaign is so unique because we have gotten to a point where the candidates understand Facebook's dramatic influence on the outcome of the election either way. And so we're going to see a transition from candidates blaming the media for perception problems and a transition towards blaming Facebook. We've already seen Warren and Biden campaign directly based on Facebook. We've seen Trump criticize Facebook, and so I think that it's correct to call this a risky strategy. And Buttigieg has not been as hard on the company, and maybe personal relationships are part of why.
Jeannie, does this give you more pause for concern about tech's outsized influence on politics?
It absolutely does. It plays into what Elizabeth Warren has been saying all along, and quite frankly, not unlike what Donald Trump ran on in 2016, that there is this connection between big tech, big pharma, these big moneyed corporations, and Washington, D.C. That's what Elizabeth Warren's entire campaign has been built on. And, I would just add one thing to this. We heard in the third quarter, Elizabeth Warren became the top draw for tech employees. And so in playing this strategy in this game, Mark Zuckerberg is giving to somebody who certainly is the #2 draw of tech employees, but not the #1. So he also risks alienating his own employees, and that is a big risk for the company as well. So I think almost from any angle, you have to be very careful when you walk down this path, and I hope he knows that at this point.
And Jeannie, we pushed the story forward to the 2020 election. And earlier in the conversation, you brought up the ad really highlighting Facebook's position of free speech and taking an ad, even if it is false, and not wanting to be a fact checker, but being a platform of which all ads, all political ads, can be out on the platform. Do you agree with Facebook's position on that?
I think that they have a really big problem when it comes to this, and Elizabeth Warren has underscored that. I think they have every right to do this, but I think their response again was problematic when they suggested they're doing it because, like networks, they want to remain neutral. Well, they've said all along up until that remark that they didn't want to be regulated by networks. You cannot have it both ways, and this is where, again, I think they have to be very, very clear as to who and what they want to be. And I think Elizabeth Warren, with this ad, and she is not alone, she's just the most well-known of people to challenge them on this, has really forced them into a corner here. And I don't think it's going to be long, regardless of who is elected, until we're going to see some form of regulation that Facebook probably isn't going to welcome.
And Sarah, did we learn anything else new today around election security?
Absolutely. We learned that Facebook has taken down even more misinformation campaigns from actors, including in Iran and in Russia. And Zuckerberg even mentioned China on the call as another entity that may try to meddle in the United States presidential elections. And so I think that it's fair to say that this is still a whack-a-mole problem, that they're still building up their defenses here, that it's safe to say that the problem has not gone away. Whether it's gotten worse, I mean, I think the company has understood how to solve problems similar to what Russia ran in 2016, but they're going to keep coming up and they're going to change in their nature. So the company is staying on alert. That said, I think that we should not just look to the foreign misinformation that is spreading on Facebook, but also the way that domestic players are using Facebook ahead of the election, and some of the hyper-partisan content and misinformation and ads are going to become an even bigger question as we get closer and closer to the election.
And Sarah, we're also getting closer and closer to Wednesday. What do we expect quickly here from Mr. Mark Zuckerberg on Libra on Wednesday?
Well, it's going to be primarily about Libra, but once he's on the stand, they can ask him about whatever they want. And I expect that they will also ask about some of these issues with misinformation ahead of the election, about things like problems with discrimination in their ad targeting. That was a big issue for this committee, especially when it comes to housing. So once he's on the hot seat, this hearing could last for hours, and we could cover a lot of ground. So stay tuned, not just for discussions on Libra, the controversial cryptocurrency, but also on other things that have come up and will continue to come up with the election ahead.
Professor Jeannie Zaino and Bloomberg Technology's Sarah Fryer, thank you both for joining. And coming up, SoftBank to the rescue. We have the latest on Wework's latest plan to be revived. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. More twists and turns for Wework. Bloomberg has learned that SoftBank is planning to take control of the company, one of the Japanese conglomerate's biggest investments. Bloomberg Technology's Ellen Hewitt joins us with the latest. So SoftBank taking control, but is this what Wework wants?
And to be clear, we're not sure yet that this is happening. This is more details that we have on the deal that SoftBank is proposing. So to be clear, it's kind of similar to what we reported on late last week, but with some new details. So it sounds like the package they're putting up for consideration by Wework's board is going to include a debt package, as well as several $billion. We've reported up to $3 billion of a tender offer for existing investors and employees. So this is something where the package, this is a way that SoftBank would potentially get control of the company if the board agrees to it. Again, they are still considering this, as far as we know, against a competing offer from JP Morgan for a $5 billion debt deal that could also get them the cash they need.
And I'm glad that you brought up that competing offer, because every day it feels like they're weighing the two. Any sense of what the board finds most important to the company?
Yeah, I think there are competing interests at play here. So you have to imagine if you're, for example, a serious stakeholder in Wework, but not SoftBank, you anticipate that a SoftBank deal would mean that you would get diluted. A debt deal, on the other hand, could, get the company an injection of cash without needing to do additional dilution. However, that's pretty risky. It's going to be a big burden on the company to be paying back those loans over the next X number of years.
And walk me through a little bit of that valuation, because our colleague Tim Kolpin wrote about this in his latest opinion piece, that SoftBank actually could still come ahead, because every time they invest, they're lowering their average price. So a big IPO could still benefit. But the other stakeholders who got in late, they're not seeing their average price in which they're investing drop off. What does that mean for them?
So, right, you're watching the valuation of Wework drop rapidly. So as we talked about, in January at their last funding round with SoftBank, at least part of that round valued the company at $47 billion. Now these deals we're talking about floating the valuation somewhere around $8 billion. So that's a huge drop. Again, as you mentioned, SoftBank, if they go forward with this, would be buying a lot more stake, probably in a secondary offering at a valuation of maybe around $8 billion. Whatever the exact number is, you're right, they're lowering their average price for the shares that they bought, while later investors are still going to be stuck at maybe having bought in at 20 or higher billion, and that's going to, I think, create maybe some tension between different investors, and depending on when they came in, they may be ending up with a raw deal compared to SoftBank, who has a chance to lower their average price.
Well, and at the end of this, how will SoftBank be judged? Throwing bad money at more bad money, or if they can turn this thing around, be seen as a hero?
I mean, if they can turn it around, that's going to be incredible, both I think for their reputation as well as for the financial outcome that they would like to see from their investment, which, as we've talked about, is in the tens of billions of dollars, or above 10 billion at this point. Again, reputationally, I think they're at risk. They used to have this halo around them that said, you know, if you get money from SoftBank, it means they're investing in you, and they're going to make you the king of your industry. I don't know that people are still feeling that way. That may affect their ability to get into deals in the future.
And we keep hearing a little bit of that every day, every day. Thank you. That was Bloomberg Technology's Ellen Hewitt. And coming up, we speak to the CEO of Silicon Valley's newest unicorn, Instabase. We take you inside the company and how it got its valuation. That's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Silicon Valley got another addition to its stable of unicorns on Monday. That's Instabase. The business tools company Instabase says it has raised $105 million, now at a $1 billion valuation. But most people haven't heard of the company until today. Instabase website offered only a single sentence saying it, quote, helps solve problems and create new breakthroughs. So here to tell me more about the company and its latest evaluation, it is Instabase CEO Anand Barwaj, and also with me, Sarah Cannon, partner at Index Ventures and one of the backers of Instabase. So Anand, let me start with you. Your website puts it very clearly. Why does the world need another computer? Answer that question. What's your business model?
Yeah, so I think before the business model, basically the way to look at it is like if you go to your iPhone today, you have a dozen of apps that you can find to even get food delivered at your home. But if you go to some large bank or insurance company, they don't have an app store where they can find an app for, let's say, income verification or claim processing. And the question is, why is that? Like, why there doesn't exist any? And then we try to answer that question, like what is missing? What does the world need from that perspective? And then we looked at what are the key building blocks and tools that needed to be built. And that's what Instabase is. It's basically a platform that gives you a number of tools and building blocks that businesses can use to build new applications that helps them automate their business.
And the business model, how do you make money?
So we sell to large financial institutions. So currently, like more than 50% of the top 10 financial institutions in the US are our customers.
Sarah, talk to me. Amid all the scrutiny of the public markets, how important is it to at least be able to see the path to profitability? Is it 5 years? Is it 10 years? What is that timeline?
The key is to invest in a company with a great business model. And the great thing about what Anand and his team have built at Instabase is that it's really a rare opportunity to build a generation-defining business. So they are enabling humans to do their best work. So if you think what Apple did for people in their consumer lives by giving them an iPhone where they could get everything on demand, that's what Instabase is going to do in the enterprise through their products by enabling banks, healthcare companies, insurance companies to build kind of all the processes that they need to do their work to deliver more value to customers. So to answer your question, we really do want to have business models that work today and will work in the future. The great thing about Instabase is we talked to a number of customers who are already paying millions of dollars for the product, with a long line of others that wanted to do so. And the company is cash flow positive today. That could change if they invest in growth, but those are certainly fundamentals that we feel good about today and in the future.
Has the pressure to see that path within a certain time frame increased as of late?
I would say we focus on it today and in the future. So I think certainly in a rich valuation environment, which we are definitely in, I mean, multiples are at historic highs. You want to invest in companies where the potential is very large. You want to invest in outlier businesses that really can deliver that return even at those high valuations.
So she mentioned valuations, $1 billion. What was the most recent funding round going to be used for?
So mostly we'll spend that money to scale our go-to-market function so that we can scale for different industries. So currently, most of our customers come from banking and insurance, but going into logistics and government and healthcare, and also, of course, scaling our R&D efforts so that we can build the app store and scale the number of apps that are present for different kinds of industries.
And how careful do you have to be that growth at any cost is not acceptable in this market environment?
So we have had really good business model so far, and we have been cash flow neutral or positive so far. We haven't spent any money that we had raised from Series A so far. And as long as we are disciplined and we continue to be disciplined, I think we can grow without getting into trouble.
And Sarah, you talked about the big valuations. As you take a look at your IRR, how do you make sure that you are finding good businesses, but also being aware that there is a lot of cash chasing too few good businesses?
That's absolutely right. So the way that I think about it is you need to be in a huge market opportunity that can sustain an even larger company. So even if you're entering at what is high valuation, if there's an enormous market opportunity, you could still generate a 10x, 20x, hopefully 100x return at these levels of entry valuation.
You know, we talk a lot about unicorns here in San Francisco, and I wonder, is reaching that $1 billion valuation exciting, or does that increase the pressure and the scrutiny? And that's something that up until now you have tried to stay away from.
We try to basically execute the company as what is necessary for us to execute. So we look at what our growth plans were and what is needed for those growth plans, and we'll continue to do the same way. So $1 billion valuation or the money that we raise doesn't significantly change anything.
And Sarah, I pose the same question to you. Is it helpful or hurtful?
I think, you know, it will enable them to attract the best talent in the world, and that's what attracted us to the business in the first place. And I think given the demand that we were seeing, it'll enable them to kind of execute against that more quickly and maybe expand into other industries. So I think it just enables us to accelerate what Anant and the team were already planning.
What is the biggest risk in the market right now? We talked about valuation. Is it competition from other cash, other investors? What do you see as the biggest risk in the market?
So this may hark back to my previous life as an economist, but I do think that there are macro risks, and I think that's, you know, the valuation environment has been what it has been for 9 years. So what's going to happen kind of more broadly? Are we looking at tougher times, and how will that impact technology? It could be different this time because people have raised much larger funds, and so they have a lot of kind of dry powder chasing deals. So there could be a lag, but I'd say that's the biggest risk.
How much extra scrutiny have you gotten in the past 6 months over corporate governance, for example?
We have started having board meetings more regularly,
Yeah.
but apart from that, nothing much. I mean, from the perspective, we try to be transparent and just give all the details to the board and keep them aware of all the progress and all the updates that are necessary.
And did those pressures increase given the focus on Wework's corporate governance, and then in response, you figured out that you needed to have more board meetings?
No, I don't think it had anything to do with any external situations. Every company runs the quarterly board meetings, and that's just a standard procedure, I think.
Instabase CEO Anand Bharwaj and Index Ventures partner Sarah Cannon, thank you both for joining me.
Thank you.
And now coming up, bypassing the ban, U.S. companies are still waiting for the official go-ahead from Washington to sell to Huawei. But in the meantime, some are still supplying the Chinese telecom giant. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. 5 months ago, the White House banned U.S. companies from supplying Huawei, but licenses will allow some businesses to keep on working with the Chinese telecom giant. But to date, firms still don't know whether or not they can work with Huawei. Now, despite the ban, some companies like Micron and Intel are finding ways to continue supplying Huawei with parts. Here to tell us more, it is Bloomberg's Ian King. 5 months later, broadly, where do we stand?
Well, I think, you know, the way to summarize it is that neither side is particularly happy with what's going on. And when I say neither side, I mean the hawks in Washington who want this company, which they regard as a threat to national security, to be shut down, to be closed off, haven't had their way. You know, Huawei is still arguably thriving. And on the flip side of that, you have US companies which are suppliers to Huawei, which get a big chunk of their earnings from that company, are saying, can we do business with them? Can't we? Under what circumstances? When will we know? And they don't have an answer to that.
And you've been covering those companies from the U.S. technology side. What has been their biggest source of frustration?
Again, they don't know how it's going to pan out. On the one hand, there was this order that came down, an entity listing for Huawei, so they largely shut down contact with the company. Then they looked through, they had their general counsels look at what the rules were and decided, oh, actually, we can kind of do business with these guys to a certain extent. So they started off, resuming contact, started off supplying Huawei again. But then we've got the trade talks, we've got more rules coming, we've got when are we going to get a license to know what we can do long term. And again, they're deeply frustrated and believe, as you mentioned, that they might be losing market share to overseas competitors.
And how successful have they been in skirting around some of the export bans or the licenses so that they still are able to do business with Huawei?
Yeah, I think it very much depends upon the company, the types of products that they supply, and where indeed those products are designed and made. And so it really does vary from company to company, but it's undoubtedly true that some of these US companies, big names, have shown an appreciable negative impact to their earnings, to their revenue growth because of this trade dispute and because of directly what's going on with Huawei.
And you said that there has been a conflation between trade and Huawei. From the chip makers' perspective, what have they said? Is it a national security concern or a trade concern?
Yeah, they're very concerned about that, and they want, again, specific guidelines. What's Huawei doing that's naughty? What can we not supply them with because that would hurt American security interests versus the interests of the United States in terms of a thriving economy and a thriving chip industry, which means we need the revenue, we need to be able to supply stuff that, say, Huawei can easily get from Samsung Electronics in Micron's case. So they want rules, they want a definition, and they haven't been given that. They've been promised it. Remember, we reported that the Trump administration had a meeting with senior technology executives, promised them licenses are coming soon, it'll all be sorted out. Still hasn't happened. And the concern is that until China starts buying soybeans or something that really isn't connected to them, they won't get that clarity.
And what is that concern about market share, where they say if we don't sell to Huawei or to China, someone else will, and then we will end up just being hurt because we lose market share? Is that valid?
It's absolutely valid in the case of some companies and not so much in others. Let's face it, there's no real replacement for a high-end Intel microprocessor right now. Huawei just can't get that. Other stuff, memory chip, absolutely. Micron had a huge business with Huawei. Those chips can absolutely be replaced overnight by just going simply and ordering them from Samsung or SK Hynix in South Korea.
And we are coming up on earnings season where we will hear from a lot of these chip makers. What do we know about the real impact on the top and bottom line? And perhaps more importantly, going forward, the impact that this still could have on their financials?
Yeah, that's a very good way to set things up. It's a massive asterisk, right? The promise that the chip industry made, the promise that sort of investors bought into was that come the second half of this year, we will have cleaned out inventory, everything will be fine. At the same time, they're having to say, if the trade dispute is resolved, if we have clarity on what we can do in China, they don't have that, so we're going to continue to see those asterisks, I think.
And finally here, any sense on when that resolution comes? Does it come as part of a trade deal in phase 2? What does the resolution look like?
Yeah, that's a wonderful question, and if I had the answer, I think I'd be a lot happier. But everybody thinks that it's going to happen as a quid pro quo basis as part of the negotiations, and hopefully there'll be some resolution as the year goes on, but that's about the best estimate we have.
Bloomberg's Ian King, thank you so much. Now, there's also a growing chorus on the benefits of direct listings as an alternative to an IPO. That tune being largely led by venture capitalist Bill Gurley of Benchmark. He is said to have planted the idea with Slack CEO Stuart Butterfield, which listed in June. Spotify led the direct listing trend in 2018, and so far Airbnb has indicated it is also leaning towards a direct stock listing next year. I caught up with New York Stock Exchange President Stacey Cunningham earlier Monday on these topics.
If you take a step back and you think about why companies choose to go public, there are typically 4 reasons. 1 is access to capital so that they can raise some money. 2 is having the credibility of a public listing and the visibility of that event. The 3rd is liquidity for early investors and their employees who very often have been getting paid in shares or options of stock and want to be able to use that and go buy a house. 4 is currency so they can engage in M&A. Now, traditionally, access to capital has really been the primary driver in raising money. And what we're seeing now is for many companies, because they're much larger companies in the private market space, it's more the liquidity for their employees that's driving the public listing. So that allows you to ask yourself, can we decouple capital raising from a public offering? And that's what Spotify really started. Barry McCarthy, the CFO of Spotify, asked that question. He said, why do I need to go with the traditional IPO method if I'm not actually looking to raise money? And so that was really the genesis of the direct listing.
How does your role change between a direct listing and an IPO?
Our role, we've been at this for 227 years. We've been helping companies come to market so they have access to capital for a very long time. The IPO mechanism that we all talk about so much and are so familiar with has really only been around since the early 70s. So that doesn't change really our job. Our job is to help find price. We are uniquely positioned to do that at the New York Stock Exchange because we have a market maker that's assigned to trading each one of these securities. So with the direct listing, they're looking for that opening price in the morning to establish what the value of the company is and where supply meets demand. And so that's the job we do here every day.
And you are in San Francisco because you're attending meetings and conferences about direct listings. In your conversations, what do you hear from underwriters who it used to be profitable to help underwrite an IPO. Now they're trying to get more involved in direct listings. What do you hear from those conversations about how they're trying to get more involved in direct listings?
I think they're trying to serve their customers. And as their customers' needs have changed, the banks are looking at how they can be helpful and provide resources to their customers. So they're very engaged on the process. And you know, we've seen them, you know, take a real leadership position on how we can use this as an additional tool, an additional product they can offer their customers. And that's what we're seeing happen.
You had said that you recently are getting more tech companies on the NYSE, which previously they were listing on the NASDAQ because you modernized your rules and you allowed non-profitable companies to list. But was that a good decision? Do you consider yourself perhaps maybe an enabler in some of those unprofitable companies?
Yeah, I think many people don't realize that the New York Stock Exchange listing standards didn't allow companies that were pre-profitable to list on the exchange. And many of today's companies over the past several years have come to the public markets prior to being profitable. And so we modernized our listing standards. And since then, the vast majority of tech proceeds have actually been raised on the New York Stock Exchange as a result. But the question that you're getting at is, are those companies good for the market? And it's very important for a company, you know, it's not unusual for them to be pre-profitability when they list, but then have a pathway to profitability. What's their plan? How are they going to get there? And investors can share in that process, and ultimately they do become profitable. And we've seen that with tons of companies out there.
Quickly, finally here, how has Wework changed the market?
I think there's a conversation. I'm never going to talk about specific companies, but there are conversations that the market is having around discipline and governance in companies, around the valuations of private markets versus public markets. And this is not it's not a story about one specific company. It's a story about trends we're seeing in the market. When there are fewer investors determining the valuation of a company, it's not price discovery like we see in the public markets where you have many, many investors. Nobody can value. There are tons of smart people in the private market space. Nobody can value a company the way the public market does. And that's real value that the public markets give to investors and employees and all Main Street investors as well.
That was NYSE President Stacey Cunningham. And coming up, we speak to the man leading the U.S. Department of Justice's China Initiative. Our discussion with U.S. Assistant Attorney General for National Security, that is John Demers. He's next. This is Bloomberg. It is no secret that the U.S. has long been after China to stop IP theft and force technology transfers. Those are two key parts of the Department of Justice's China Initiative. And the man leading that effort is John Demers, the Assistant U.S. Attorney General for National Security. On Tuesday, he will be part of a discussion in San Francisco on that very topic. But today, he joins me. So thank you so much.
Thank you.
We got a great list of all of your initiatives that you have been doing. When can we expect corporate espionage, technology issues that are most important to the companies that have the most to lose when it comes to China?
Right. So as you see from the initiative itself, the initiative was started really in response to what we see as a persistent, concerted, very well-resourced and funded effort to take intellectual property from American companies, including companies right here in the San Francisco area, and transfer that intellectual property to China in what we call a sort of a rob, replicate, and replace approach to technological development. So you rob the intellectual property of an American company, you replicate the product in China, and then you replace the American company on the Chinese market first, and then if all goes well, on the global market. And that was what we were seeing in the intelligence and why we started this China initiative.
A lot of this has been done by the DOJ.
Right.
What are you doing that's new to help companies with the most to lose with China?
So what we're trying to do is a lot of outreach to companies and to show them the benefits of coming forward and telling us when they think some technology has been stolen early. Sometimes what may seem like an employee misbehaving is in fact somebody who's been co-opted by the Chinese intelligence services and is stealing on their behalf. So we don't want companies to just try to handle this on their own, because they need to understand that they're up against a nation state, right? And companies just don't have the resources and the knowledge that nation states do to combat that.
Do you feel like you have the knowledge and the staffing and the resources to take on a huge state?
Right. So a lot of what the China Initiative is about is really empowering and harnessing the U.S. attorneys' offices around the country, which is where most of our prosecutors are, really focusing their attention on this problem and letting them know from our main justice perspective, from the Attorney General's perspective, that this is a very important priority where they should be putting their resources in order to help companies tackle this problem.
What about future issues? A lot has been said about AI, robotics. Do you and the state attorneys, as you mentioned, have the resources to also now expand to all of those future issues?
I think that there are all different areas of technology, but the problem remains the same, right? The core problem of Chinese theft, whether what they're stealing is in the area of AI or robotics technology or biopharmaceuticals, et cetera, their tactics are all the same. And so if we're ready and we're empowered to reach out to companies to work with them on defending themselves, then I think that's technology agnostic, right? That will work regardless of what the Chinese are after. Now, we know what the Chinese are after because they've laid it out in their Made in China 2025 plan. And they're after basically 10 very large technological areas, everything from commercial airplane technology to new materials to biopharmaceuticals, on, that they think will be at the forefront, and they're probably right about this, of technology in this century.
What is the solution? Is it export bans, sanctions? What's the right solution to solve the problem?
There's no one solution, I think, and certainly our cases by themselves are not the silver bullet. The solution is working together with the private sector and government to watch out both for cyber intrusions, which is one tool, but also what we see increasingly in our cases is insider threats. So many of these cases, as the Chinese have shifted their resourcing to using their intelligence services to do this theft, a lot of these cases are now the result of insiders having been co-opted by the intelligence services and then sending information or stealing information and bringing it to China.
We've talked a lot about CFIUS, which we should say is the Committee on Foreign Investment in the U.S. Do you expect to see more CFIUS involvement going forward?
Well, CFIUS was, of course, expanded just last year by Congress, looking at new technological areas, but also guarding against the theft of sensitive personal data, which has also been an issue of ours. The Chinese are very interested in personal data of government employees and others. You saw that as early as the Office of Personnel Management hacks, where everyone who had a security clearance, their data was stolen. And we see the Chinese continuing to be interested in personal data. It's of great value to them when they figure out how to target people. So the more that I know about you, for instance, the easier it will be for me to target you if I were an intelligence officer. I could pretend to have areas in common, et cetera, and then start to develop a relationship in that way.
We have to talk about Huawei. Is it a national security issue or part of the trade fights?
Well, I'm the national security guy, so for me it's a national security issue. We have 2 cases going on against Huawei right now, one involving the theft of intellectual property, one involving a sanctions and bank fraud case, which is also a national security case. And then the broader concern on the national security side with Huawei is the influence of the Chinese government on Huawei and other large Chinese companies, and the use of the technology on the telecommunications network that we're all using every day for our everyday activities, and whether the Chinese government can then take advantage of the fact that Huawei is on American networks or on the networks of our allies around the world.
When you look at China, in the China Initiative, what is your biggest concern? Is it cybersecurity? Is it IP theft? Is it Huawei? What is the biggest issue when it comes to China?
I think there's a variety of issues. My biggest concern is that they're using their intelligence services to target American companies the way that they've used them to target the government for years, and that American companies will find it very difficult to defend themselves against the intelligence services of one of the most sophisticated nations on the world.
U.S. Assistant Attorney General for National Security, that is John Demers. Thank you for joining me.
Thank you.
And when it comes to a crisis event at a school or a city center, seconds can make the difference between life and death. We speak to one company using technology to make sure that every second counts. That's next. This is Bloomberg. Mass shootings at a school, that is a nightmare for any parent. And schools across the country are looking for ways to help ensure safety across their campuses in an event of an emergency. One company working to leverage technology to notify on-site personnel and first responders is Rave Mobile Safety. Their products, like their Panic Button app, are being used across the U.S. by law enforcement, schools, and more. Most recently, all kindergarten through 12th grade teachers in Louisiana will have access to that technology. For more, I bring in Todd Pete. He is the CEO of Rave Mobile Safety, and he joins me from Boston. Todd, thank you for joining me. Talk to me about the business model of the app. How does it work?
Sure, Taylor. Thanks for having me on. So first of all, I think it's important to understand that our business is really safety, and we believe that you have a right to be safe where you live, work, and play, and all our solutions are really revolving around that. So for the Panic app in particular, we license this technology to public safety agencies and or school districts. We're deployed in almost 10,000 schools across the nation at this point. It is software as a service, so there's an annual fee. We handle all the training, maintenance, deployment services. So in particular in the state of Louisiana, for example, we work closely with the state police department to roll it out across the state.
And what are some of your future initiatives to further integrate with first responders?
Yeah, that's a great question, Taylor. We actually are pretty broad in our footprint, well beyond just school safety. We do a lot in 911 centers, emergency management agencies. Really, we view our customers, and it's anybody that's looking to better connect with the populations they protect. So between 10,000 schools, we've got half the colleges and universities in the country, and a lot of 911 centers and responder agencies. And we do a lot around enhancing communication and collaboration. So if you think about something like an active shooter situation at a school, it's not handled by just the resources at the school. You need to involve local responding agencies, EMS, maybe potentially other schools in the area to let them know that there's an incident going on. And there's a lot of information that needs to be shared in that context, whether it be a floor plan, whether it be simple communications about where the shooter is and better location information, or whether it be streaming video. And that all needs to be done in the context of all the individuals that are together working to really resolve the issue. That same same issue kind of translates down to a much smaller incident, whether it be a heart attack or a student having an asthma issue. You need to make sure the responders know the nature of the incident and how best to get to the location of that incident.
And what does the data show you about how effective this is?
Yeah, you know what? It's actually kind of humbling to be able to speak to people that we've helped save. We had an incident in one place where the responders claimed they saved 11 minutes or shaved 11 minutes off of response time, and I was actually able to meet the father that was commenting about how he could hug his children because our software helped. I'd like to make sure everyone understands that the responders are the ones that are actually implementing and doing this. We're not kicking down the doors to a fire, but it's pretty gratifying to know that our software can be used to help in that process. We've helped in thousands of school incidents across the country and often shaved minutes, if not in just seconds even off of a response can be the difference between life and death.
How are you protecting our data?
Yeah, that's a great question, and clearly one that we are asked often. You know, we do a lot and invest, as most companies that have sensitive information. We do a lot of things to protect and encrypt the data and regular audits. So it's a major part of our business and a significant investment for us.
Talk to me about some of the biggest concerns that you get from investors outside data privacy. Is it valuation or profitability?
You know, we're blessed with a fantastic investor in technology crossover ventures. When they invested in us earlier this year, they saw the opportunity to really disrupt what in many ways is a static industry in public safety. So, you know, the questions were probably the same ones that are asked of any enterprise. What are our retention rates? So they're phenomenal. You know, how do they see growth internationally? How do we continue to expand the product portfolio? We've got some really great loyal customers. So all of those metrics added up to a significant valuation for us.
So Todd, 20 seconds here. What are those international expansion plans?
Yeah, so as you can look in the news and see natural disasters and incidents across the country, we are actively looking today to expand into multiple markets. A lot of our solutions are applicable, and frankly, some of them are less so internationally. So we're actively working to deploy those internationally now.
Todd Piatt, CEO of Rave Mobile Safety, thank you for joining me. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.